I'm Joseph Gildenhorn, Chairman of the Board of Trustees of the Woodrow Wilson Center, and let me take this opportunity to welcome everyone here tonight. It's really a marvelous turnout, and I thank you all for coming. Tonight's dinner is the culmination of a very fascinating and most interesting day of meetings and talks, a full day indeed. We've been going on all day. This morning we had a very informative discussion panel on national security issues led by Wilson Center's Vice President Rob Litwack. And the discussion included 3 experts, and these were Professor Bruce Hoffman, a Wilson Center public policy scholar and security expert, and a professor at Georgetown University. We also had Elizabeth Buell-Miller, the Pentagon correspondent for the New York Times and former Wilson Center scholar, and Mark Grossman, Vice Chairman for the Cohen Group and former Undersecretary of State and a current Wilson Center scholar. Our morning program continued with a report by Aaron David Miller with an assist from Sam Donaldson. Aaron and Sam just returned from Israel and the Palestinian territories, and Aaron gave us an update and perspective on the current political situation in the area. And immediately following that briefing, we had an insider's presentation on Pakistan and U.S. relations by one of our public policy scholars, Malika Lodi, former Pakistani ambassador to the United States, and Bob Hathaway, director of our Asian program. We ended the morning activities with a briefing on Canada delivered by our Canada Institute director, David Biet. His Excellency Gary Dewar, the Ambassador of Canada, hosted us at the beautiful Canadian Embassy for lunch, where we had a frank discussion on Canada's important role as our neighbor and the current relations with the United States. And this afternoon, we returned to the center where we heard from 2 experts on the economy, Paul Bluestein, a current Wilson Center scholar and former staff writer for the Washington Post, and David Wessel, economics editor for the Wall Street Journal, and author of the book In Fed We Trust, and a former public policy scholar. And tonight we are continuing our focus on the economy and finances, and are very, very pleased to welcome the Chairman of the Federal Reserve System, Ben Bernanke. Chairman Bernanke, we are so thankful for you for being here, and we look forward to your comments. Today's discussions continue to remind us of the high standards of excellence the Wilson Center upholds day in and day out. At this time, I would like to recognize our board members who are here tonight and some special guests. We're pleased to have Sandra Gerber, our Vice Chairman of the Wilson Center, the Honorable Charles Cobb, if Chuck is here, I'm not sure, Robin Cook, the Honorable Charlie Glazer and his lovely wife Janet, Susan Hutchison, and Ignacio Sanchez. We have some public board members who are here and their designees, and I'm pleased to welcome Jim Leach, Chairman of the National Endowment for the Humanities, Anne Marie Slaughter, Director of Policy Planning for the U.S. Department of State, Judith Leonard, General Counsel of the Smithsonian Institution, and Christine Kalk, Senior Analyst and International Coordinator, National Endowment for the Humanities. We also have some former trustees, and I'd like to introduce them. Dr. Carol Cartwright, Joe Flom and his wife Judy, Don Garcia, Henry McPherson, David Metzner, Paul Hay Park, Senator Richard Schweitzer and his wife Claire, and I'm not sure Alan Weinstein is here, but Alan Weinstein and his wife Adriana. Also Dan Lamotte and James Reichley and his wife Mary. And I'm also pleased to welcome new council members, which are very supportive of the Wilson Center. And we have Ruth Dugan here, Margaret Goodman, Tom and Claudia Hencliffe, Tom Mansbach, Bob Morris, Diana Davis Spencer, and Diane Takmanji. Fine, now we can have a round of applause. Finally, a special word of thanks to Lee Hamilton. As most of you know, Lee is stepping down from his role as president and director. And I'd like to take this opportunity to thank him for his enormous commitment to the center and to our nation. His contributions cannot be overstated. Thank you, Lee and Nancy, for your leadership and guidance, which will be sorely missed. Now, please enjoy. Now, please enjoy your dinner.
I think what we'll do this evening is interrupt your dinner. We're going to begin the program now, and we'll wait to serve dessert until after the program. We have a number of people here tonight who have very busy schedules, and we want to move this program along promptly. I would like to, before I introduce our program, I'd like to say a word of welcome to several people that are here. I want you to know, I think it was introduced a little earlier, but we would not have a Wilson Center had it not been to the work of Joe Flom. Joe is here tonight. Joe, would you stand so they can greet you? He was chairman of the board. And his wife, Judy, is with him. We're delighted to have the Floms. I want to introduce a fellow from my hometown, Evansville, Indiana, who is here, David Hamburg, and his wife, Peggy, or Peggy's their daughter. This is Betty, Betty Hamburg. David, you and Betty stand up, if you would, please. Many of you may know David. He was president of the Carnegie Foundation. He's had a marvelous career. One of the really great humanitarians in this country. There are several former colleagues of mine here that I want to introduce. Andy Ireland, congressman from Florida, and his wife Nancy. Would they stand back here? And I'm going to test your knowledge of politics a little bit here. We have a former vice presidential candidate. I think the right year is 1976. He was vice president for Ronald Reagan when Ronald Reagan ran for the presidency. Dick and Claire Schweikert are here, I believe. Dick, would you stand up? Here. He, of course, was senator from Pennsylvania, also secretary of HHS a few years back. We're pretty heavily loaded with Pennsylvanians. Tom Ridge is here, I believe, tonight. We're delighted to have the governor here. Former Secretary of the Department of Homeland Security. I want to introduce two people who are very important to us because they help us with the appropriations of the Wilson Center at the United States Congress. And they may be the most important people here, so far as I'm concerned. Jenny James and Chris Topic are here. Would you stand, Jenny and Chris? They do marvelous work on the staff of the Appropriations Committee. I'm delighted that Jim Leach is here. He's now chairman of the National Endowment of Humanities, a former colleague of mine as well on our board. I'm going to be introducing Sam Donaldson in a moment, but I want to say that his wife is here, Jan, and we're delighted to have you as well. We have the president of Siemens USA, Eric Siegel, is here. We're delighted to have him with us. We have several ambassadors with us tonight. Ambassador Han Duck-soo from the Republic of Korea. Would he stand, please? Over here. Ambassador Jonas Hafstrom from the Embassy of Sweden is with us. Ambassador Ichiro Fujisaka from Japan is here. And Ambassador Arturo Suracan is here from Mexico. We're delighted to have him. I think the Brazilian ambassador arrived. I didn't see him personally. That's Ambassador Vieira from Brazil. And we have the Charge d'Affaires, Johnny Maloto, from the Embassy of South Africa, who's with us as well. Now, I hope I've hit everybody I'm supposed to. This is a wonderful evening. I want to thank Joe Gildenhorn for his gracious remarks about my tenure at the Wilson Center. May I say to you that I came to the Wilson Center planning to be here about 4 or 5 years. I've stayed 11 or 12. And one of the principal reasons I have is because I've had the honor to work with Joe Gildenhorn and Alma. And I'll tell you how loyal Joe is. He's so loyal to the Wilson Center that he's here tonight when his grandson or granddaughter is graduating from high school. Now, by golly, that's really something. And Joe, we appreciate your leadership. Now, tonight, we welcome the Chairman of the Federal Reserve, Ben Bernanke, to the Center. He's an academic thinker and a policymaker in the tradition of Woodrow Wilson, a world-class scholar, and like Wilson, a Princeton professor. Dr. Bernanke has become one of the country's most important and most respected policymakers. He happens to be greatly indebted to Woodrow Wilson. One of Wilson's major legislative achievements, as many of you know, was the enactment of the Federal Reserve Act of 1913. So not to put too fine a spin on it, and skipping over an awful lot of history, I just want to point out that I don't think he'd have a job today if it hadn't been for Woodrow Wilson. Over the past 5 years, he has faced tremendous challenges, adversity, and frustration. But that's the lot of an avid Washington Nationals baseball fan, which he certainly is. And he and I and the sports fans in this hall know that with the first pick in tonight's amateur draft and Steven Strasburg's debut tomorrow on the mound for the Washington Nationals, things are looking up for the Nats. But that's not really my purpose tonight, to talk about the Nationals. We know him best as the 14th Chairman of the Federal Reserve, first nominated by George W. Bush in 2006, renominated by Barack Obama for a second 4-year term last August. His scholarly expertise is the Great Depression and its causes, and that, of course, prepared him for the historic task of responding to the second greatest financial crisis in our country's history. He's been at the center of the extraordinary efforts of this country, indeed the world, to rescue us from the frightening near collapse of the financial system in the fall of 2008 by making available really trillions of dollars of official funds and helping us to understand better what happened and how to respond. For his work, we can only offer our appreciation, our support, and our fervent hope that he and his colleagues will succeed in enabling healthy and sustainable economic growth. The other day, I saw a picture of him standing on the Great Wall of China. He was, of course, much more than an ordinary tourist. For some reason, my thoughts turned to one of his predecessors, William McChesney Martin, who was chair of the Federal Reserve from 1951 to 1970. And as I recollected, at least, his travel schedule consisted of trips between Washington and New York. That must seem like ancient history for a globetrotter like Dr. Bernanke. His responsibilities take him from the capitals of Europe to the Great Wall of China to Jackson Hole, Wyoming, and of course many other places, illustrating, I guess, the interconnectedness of the 21st century global economy. Prior to his government service, he was the Howard Harrison and Gabrielle Snyder Beck Professor of Economics and Public Affairs at Princeton University. He served as chair of the Economics Department from 1996 to 2002. He began his academic career at Stanford's Business School before arriving at Princeton in 1985. He received a BA in economics in 1975 from Harvard University, summa cum laude, and a PhD in economics in 1979 from the Massachusetts Institute of Technology. He and his wife Anna have 2 children. Born in Georgia, he grew up in Dillon, South Carolina. The format tonight is not for a speech by Dr. Bernanke, but he and our inimitable president of the Wilson Council, distinguished newsman Sam Donaldson, will provide the program. Sam will interview Chairman Bernanke. I'd ask the 2 of them to come forward now, and after the interview, we'll have questions from the audience. Sam and Chairman Bernanke.
And I'm not.
Testing.
Hello. We're on. Chairman Bernanke, I'm delighted that you agreed to do this. And by the way, what do you think of the Great Wall of China?
You can see it from the plane when you come down to Beijing. It's very impressive.
That matches Richard Nixon's statement when they asked him. He said, "This is the Great Wall." All right. Let's get now to substantive matters. We seem to be in recovery from the Great Recession that we've gone through, fragile though it may be. How convinced are you that that recovery will continue at a reasonable pace? Or do you see some troubling signs that we may indeed slip back into a double-dip recession?
Well, we've gone through a number of stages here. You know, we had a tremendous contraction, a very deep contraction after the financial crisis intensified in '08 and early '09. Things stabilized in the middle of last year. And then the process, the natural business cycle process began to rewind itself, heading towards a recovery. And I think the recovery probably began sometime late last summer. And so we've been expanding now. This is the 4th quarter of expansion that we have had. At first, the expansion was caused primarily by firms building up, or at least not accumulating their inventories quite as quickly after having built up a large amount of inventories during the downturn, and by the fiscal program. So those are sort of artificial sources. And the real question that we were facing was, come the beginning of 2010, would the recovery get its own legs? Would private sector demand take over for inventories and government spending and provide a sustainable recovery path? And the news so far is pretty good. We've seen in the last first quarter and in this quarter, we've seen the consumer coming back, about 3% real growth in the consumer during 2010. We've seen firms spending more on equipment and software. So there are some signs that the private sector is picking up the baton and moving the economy forward. Now, there are various caveats, as always, and you know, macroeconomic forecasting is sort of like looking through the entrails, as I'm sure you know. But so what are the caveats? Well, one is that this, for a deep recession that we had, this is a fairly moderate-paced recovery, sort of a 3% growth type recovery. And you know, one concern about that is that it takes about 3% growth just to provide work for the people coming into the labor force. And so at 3%, 3.5% growth, we're not going to bring that unemployment rate down very quickly. It could stay high for some time. And that is itself a risk, because if people are unsure about the labor market, they'll be less willing to spend and to take risks and to be entrepreneurial and so on. So that's one concern. And another concern, of course, is in the financial sector, where we've made a lot of progress. But the banking system, for example, is still not completely healthy. We're not getting yet the full credit availability that we would like to see.
Why not?
Well, because the banks took a lot of losses during the downturn. They lost capital. They raised capital, which was very useful. But they are still deleveraging. They're still reducing the size of their balance sheets, and they're being relatively cautious in terms of new lending. And not so much a problem for big firms, but for small firms that can be a difficulty. And
Mr. Chairman, excuse me for interrupting, but you know, a lot of people say, yes, the banks, using government money, help shore up their resources, help their stockholders a lot, but are not lending, as you say. And why don't they use the government money to lend out?
Well, the government money was critical in preventing the collapse of the system in the fall of 2008. And it did do that, and that was the first and most important thing, because we came very, very close to a global financial collapse, which had tremendous consequences. Now, there has been, I don't want to overstate the case. I mean, the banks have stabilized quite a bit, and they are earning profits. And they are making loans, but not to the level that we would like it to see. Now, part of the reason that the government money hasn't gone into lending as much, besides the caution and deleveraging that the firms have done, the banks have done, is that for political reasons, essentially, the banks have decided that they don't want to have the government money. They want to give it back. And so what we've seen is that almost all the big banks have paid back the government money now. The good news is that they've paid it back in full with interest, and so the taxpayer is making money on those particular investments. The bad news is that they give that capital back to the government. They don't have it available for lending. And so they have gone to the private sector. They've raised capital there, and they will be lending, I think, but so far they're still recovering and stabilizing from the crisis.
So if I think I understand you correctly, you do not fear, with the caveats that you put in, a double-dip recession.
Well, again, this is like looking through the entrails, you know, and nobody knows with any certainty. But there seems to be a good bit of momentum in consumer spending and investment. And so my best guess is that we'll have a continued recovery, but it won't feel terrific. And the reason it won't feel terrific is because it's not going to be fast enough to put back 8 million people who lost their jobs within a few years. It's going to take a while. So even though technically we'll be in a recovery, the economy will be growing, the unemployment rate is still going to be high for a while, and that means that a lot of people are going to be under financial stress.
How worrisome is what's happening in Europe, to Greece, maybe to, Hungary today, to Spain, perhaps to Portugal, and the euro and the effects there?
Well, we're watching that whole situation very carefully. It's a very complicated phenomenon. As you know, the Europeans have a broad-based, call it European project, the goal of which is essentially to restore peace and unity to Europe after, of course, many, many years of conflict. And an important part of that project was the creation of the euro, the single currency, which the countries, not all European countries, but many European countries share. Now, the euro had a lot of benefits in the beginning. It lowered interest rates because people no longer had to fear devaluation of the currency because it was a fixed currency that they all shared. And so countries like Greece were able to borrow at relatively low interest rates not much higher than, you know, very strong credit countries like Germany. And the result was that they overborrowed, and they weren't completely clear about what their debt situation was. And recently, it's become clear that they have, in fact, very, very large outstanding debts, which are difficult for them to service. Now, this is a problem because, you know, even though they have a single currency in the Eurozone, they don't have a single fiscal authority. There's no easy way to move money, tax money, from country A to country B within the Eurozone in the way that we could move money from state A to state B in the United States. And so providing help to Greece is proved to be a difficult proposition. Nevertheless, the Europeans are committed to avoiding default in Greece and in other countries on the so-called periphery, because they fear that a default of, say, Greece, even though it's a very small economy itself, might lead to defaults in other countries if investors got spooked by the first default, and that in turn could put pressure on their banking system, which holds lots of securities from those countries and the banks and other businesses in those countries. So it's been a relatively slow process, but the Europeans have put together a program, a special purpose vehicle with the 500 billion euros in it, which is being partially matched by the International Monetary Fund.
Is that enough?
Well, it's quite a bit, and it would cover, 500 billion here, 500 billion there. Pretty soon you're talking real money.
Not to what we've been spending in the last couple of years.
Well, it's a lot of money. It certainly covers the obligations of Greece and Portugal and Spain for a number of years. So it's a lot of money, and plus the IMF is there, and perhaps more European money is necessary. But there still needs to be work done to make sure that countries can apply for it and to make sure that they can take the tough steps they have to take in their own countries to reduce their deficits and debt and stabilize their finances. Now, just last comment is that, there's a lot of uncertainty about this in the markets. We've seen 8 or 9% decline in the U.S. stock market just as because investors have gotten more risk averse. And that's because it's not clear, that investors aren't completely convinced that this problem will be taken care of. All I can say is we're watching it very carefully. We have been trying to support their efforts everywhere we can. And one thing that I'm quite persuaded of is that European leadership is strongly committed to doing whatever is necessary to preserve the euro, preserve the eurozone, preserve the European project, and avoid the financial problems that would certainly arise if Greece or another country defaulted.
You just pointed out that the Europeans also seem to be attacking their deficit problem. Now, recently you've begun to warn, as your predecessor did, when the deficits were much smaller, that it presents a danger to us. But at the same time, the Fed and the Congress continues to believe that stimulus is needed at this moment. Well, how could we reduce the deficits when we're still stimulating the economy? And at what point do we change?
Well, first, the Fed stimulus doesn't have any implications for the deficit. So that's a separate issue. So the question is the fiscal stimulus. It's a matter, I think, of time frame. On the one hand, it's really not plausible or possible for us to balance our federal budget this year or next year. I mean, the recession was too deep, the loss of tax revenue is too great, the spending to try to support the economy and the financial system too large. So we've had, obviously, some very big deficits in the last couple of years.
Do we need to raise revenue?
Well, let me finish the first part of your question, which was, so we can't reduce the deficit, we can't eliminate it this year or next year, but over the medium term, over the next 3, 4, 5, 6 years, and certainly beyond that, as our society gets older and people are becoming eligible for Social Security and Medicare, we do need to get good control of the debt and the deficit. So we need a medium-term plan, an exit strategy, if you will, that will allow us to bring our fiscal house in order over a longer period of time.
Do we have one? Do you see one?
No, not yet. I don't. What we do have is, among other things, we have a presidentially appointed deficit reduction commission, which is made up of a very distinguished group of many of them are congressmen, but others as well. And it's their assignment to provide a plan which will be presented to the Congress at appropriate time.
They have no teeth.
No, you're absolutely right. So let me just say that as you started out your question, we have been mentioning this quite a bit at the Federal Reserve. We think it's very important. We can see what problems can arise in a country if investors lose confidence in the fiscal position of that country. So it is very important that we address this problem. Now, we haven't done it yet, but we will continue to advocate strong action on this. But again, I think it's important to understand the difference between having a balanced budget next week and having one over the medium term. And it's really over the medium term that we need to get that program in place.
Do we need to raise revenue as well as cut spending in these entitlements?
Well, those are the tough decisions. This is why it's so hard. If it was easy, everybody would get the budget in balance really quickly. So Congress is just going to have to. There's only a few possibilities. What I have often said in testimony is that there's one law which I always support, which is the law of arithmetic. And the law of arithmetic says that the deficit is spending minus taxes. If you're going to reduce your deficit, you either got to cut spending or raise taxes or do both. And any one of those things is painful, and that's why Congress gets paid the big bucks to go out and figure out how to do that. And that's a political question. I'm not going to try to make Congress a decision for them. They wouldn't pay attention to me anyway. But they have to come together, and it's a tough choice, politically very tough, to try to find some ways to reduce spending and, if necessary, raise revenues to bring the deficit down to a sustainable level. It doesn't have to come to zero, just low enough that the debt relative to our economy doesn't grow and we can sustain this over a period of time.
2 or 3 questions on the financial regulatory reform bill that's going through Congress now. It'll be in conference committee, and the 2 bills that the 2 houses passed will have to be somehow merged. The Senate passed the Volcker Rule, which is not as restrictive as the old Glass-Steagall, but still would prevent banks from using their own proprietary interests rather than their clients' interests in making these trades and all of that. I'm informed that, maybe I've been misinformed, that you're not particularly a fan of that rule. Am I wrong?
Well, this is one of those yes or no questions.
Well, can't you answer that either yes or no? You like it or you don't like it?
Well, see, the thing is this, that there are many times in which a bank has to do something that looks like proprietary trading for good reasons. For example, to hedge its position. If it's got loans, then it may need to buy various derivatives to hedge those loans. If it is running a fund of some kind, then it may be, in order to attract customers, it may have to take a share of that fund, and so on and so on. So there are lots of ways in which a bank may need to be exposed to a position in order to serve its customers. Now, I think Chairman Volcker would agree that there are those circumstances, like hedging, for example, where you don't want to prevent banks from buying the assets, because that actually makes them more risky, not less risky. So the way I've looked at this is that, and the way the Senate bill, as I understand it, would work, is that it would ask it would create this separation between proprietary and non-proprietary trading, but it would ask the regulators, including the Federal Reserve, to figure out what that line means. And in particular, when is the purchase of a derivative or some other security legitimate hedging, legitimate customer service, and when is it gambling with the bank's capital, or ultimately the taxpayer's backstop. So as long as there's a reasonable process for distinguishing between those 2 categories of assets, I think that can be made to work. And as one of the regulators, we'll certainly work with our colleagues to try to make it operational.
All right. Second specific question, derivatives. As the bills seem to be written, most of them now go on exchanges. But credit default swaps, perhaps the most dangerous, certainly the most lucrative in the past to banks, might not. Isn't that a bad thing? Shouldn't we regulate them also?
Well, they will be regulated. So first of all, for everybody, credit default swaps are essentially insurance that you can buy or sell on the credit of a country or a company. And they come in different flavors. There's some that are specific to an individual company, like Ford Motor. And then there's some which are much broader, cover an industry, or for example, or a mix of CDS. So these are very important and valuable instruments because they can help you hedge, again, against various kinds of risks.
Now, but they wouldn't have to, the way the bills are going, they wouldn't have to be on exchanges.
So the CDS is an instrument that grew very, very quickly, and it didn't have a whole infrastructure that grew up very quickly with it. And in fact, this is one place where the Federal Reserve was ahead of the crisis, because the New York Fed, in particular, and Tim Geithner, who was then the president, now of course is the Treasury Secretary, had a big role in this. The Fed was very much involved before the crisis in trying to get better organization, better control of the trading of these CDS, because at the time it was pretty chaotic. And so some progress was made in getting the trading better documented, more transparent, et cetera. And the Fed is continuing to work on that process. Now, the issue on exchanges, exchanges are good. They allow for price discovery. They allow for setting up margins and providing capital so that you don't have to worry about your counterparty when you make a trade or derivative. But but exchanges aren't always practical for very, very idiosyncratic, small, specialized types of derivatives, because exchange is something where you trade large quantities of very homogeneous products. So you still need to have the ability to trade specific, individualized securities off the exchange. But that still doesn't mean they're not regulated, because in the new bill, there would be, and in the new regulatory rules, there'd be substantial capital that banks would have to hold behind it. There would have to be transparency. That is, it would have to be public what you're trading. And there'd be considerable responsibility for regulators to oversee it. One of the big concerns, in the AIG case was that they were, selling credit insurance. And when things went bad, they couldn't pay, and that's why AIG was in such deep trouble. In that particular case, there was nobody looking at AIG. The Office of Thrift Supervision looked at the thrift, but there was no agency that was really looking at what they were doing. Under the new proposals, there would be, for any systemically critical company like an AIG or any other large, complicated, complex, and interconnected financial firm, there would be a broad supervisor, in many cases at the Fed, that would have to look at that responsibility, right? And that would mean that somebody would be looking at AIG and making sure that if they were selling insurance, they had enough capital and protection so that they wouldn't go bust if things went against them.
A final question on this bill, an overall question. Richard Bernstein, who's an investment analyst of some note, says it's immensely wimpy. It's not real reform. And Richard Fisher, the Federal Reserve Bank president in Dallas, says it will do very little to rein in the big banks, in his view, that the regulators will continue to tiptoe if this bill is passed. What's your overall impression of the impact of this bill?
Well, I think overall it's lots of pieces to it, right? So there are many different components to it. But I think overall it's a pretty sensible approach, and the many pieces fit together. And let me just say, the one thing that made everybody so mad, including the general public and all of us here in Washington, was the bailouts and having to intervene with the failing firms, the AIGs and the Bear Stearns. Now, I don't regret being involved in that, because I know for a fact that if those companies had collapsed, we saw what happened when Lehman collapsed. We know that those firms had to be protected in the context of a panic in which the global financial system was at grave risk and the global economy was a grave risk. But that was a situation we didn't want to be in, and it's a situation we don't want to ever be in again. So I think the acid test of the reform will be, will it manage, will it control too big to fail? And it's really hard to know for sure, frankly, but there are a lot of very strong measures which do address that issue. To mention quickly three, one is that there is going to be a tougher set of regulations that will be used to make sure that largest firms have adequate capital, adequate liquidity, so that they don't fail so easily, that they have plenty of capital. Secondly, very importantly, there's going to be what's called a resolution regime, which means that if a large financial firm comes close to failure, a Lehman Brothers type situation, instead of having to allow it to fail because we had no tools, we had no legal ability to prevent it, we would have a set of rules, a set of procedures whereby the FDIC, much the same way that it closes down a failing bank, would be able to come in and close down that company in a way that was safe for the system. And that's absolutely critical. And then a third idea, there are many others, but a third idea would be that every company would have to have a living will, which says, here is how, if tomorrow morning I can't make my payments and this company is on the border of bankruptcy, here is a detailed description of how this company will be disassembled and broken down and put into receivership in a way that will be quick, clear, clean, but will not destroy the financial system. And so too big to fail is I think, the acid test. And if we can make sure that there's no such thing as too big to fail, then we will have eliminated by far the most dangerous aspect of the
So you believe
crisis.
this bill overall will be more helpful than not?
Oh, yes, I do. I think there are lots of different parts to it, and I wouldn't deny that there's some things I would change. But overall, I think it does address the too big to fail problem, and it does together, remember, I think I should just say that there's part of this is the legislation, but there's also what the regulators are doing. And the regulators, for example, are working right now to raise the amount of capital banks have to hold, the amount of liquidity they have to hold. And the regulators, together with the Congress, between them, can toughen up the standards quite a bit, and that's what's happening.
Well, if I thought you could and would tell us when you were going to begin to raise rates again, I would ask you. You won't tell us, will you? No.
Well,
so let me,
in the future.
All right, in the future. So let me ask you to tell us precisely what you're looking at. What will be the signs to you and your colleagues that it's time now to remove that part of the stimulus and begin to raise interest rates?
Well, the reason we don't tell people is not because we're perverse. It's because we don't exactly know when. We know what we're looking at. We know what we're looking at. Our statement has said, has laid out what the conditions are. The conditions that we're looking at are excess resource slack, essentially high unemployment and low capacity utilization.
We have high unemployment.
Have high unemployment. The second is subdued inflation trends, low inflation. We got that right now.
Low inflation.
And the third is stable inflation expectations. Those are the things we're primarily looking at, which are the state of the economy, the real economy and unemployment, and also, though, where inflation is and where it's going. So those are the main things we're looking at. I wouldn't say those are the only things we're looking at. We're looking at financial markets and other things as well. But those are the broad main areas, and that's what our mandate for full employment and price stability tells us we're supposed to look at. Now, I should say that I want to be very clear that monetary policy takes a long time to work. There are long and variable lags, as Milton Friedman once said. And we have right now a very accommodative, very easy monetary policy. Interest rates are very close to zero. And so we can't wait until unemployment is where we'd like it to be. We can't wait until inflation gets out of control before we begin the process of normalizing interest rates. We're going to have to make a forecast. We're going to have to make a judgment about when's the appropriate time to begin moving towards a more normal policy, but doing that in a way that anticipates where the economy is going to be a year and a half down the road, because it takes a while for monetary policy to work. So it will be the case that when we start the process of tightening policy, that the economy will not yet be back at full employment. One last thing is to say that we've made a lot of progress already in our exit in some sense, because, for example, many of the lending programs we put in place, like the commercial paper program and the money market mutual fund program and many others, have all been dismantled and been put away, and that process has been completed, by the way, without losing a penny and with good profits for the taxpayer. So we are already exiting from our extraordinary stance that we took during the crisis, and I view each step as just another step in the road towards a more normal policy, and I'm delighted to get there. 6
months ago, people were betting you'd raise this fall. Now people seem to be betting it'd be at least the end of the year, maybe the first of next year, at the very soonest, using the criteria that you've outlined.
Well, my late colleague Ned Gramlich used to say he used to like to read the paper to find out what he was thinking.
All right. Final question for me, and then we're going to have a short question. There are several voices now raised in the public arena saying, abolish the Fed. Ron Paul, the Congressman Paul, just one of the early ones. Mm-hmm. What would happen, except in addition to the fact you'd be out of a job, what would happen if, in fact, we abolished the Federal Reserve System?
Well, that would make us the only country in the world without a central bank. I guess the question is, what would you put in place?
They just let the money supply grow at about 3%, which is the rate of the increase in population.
Well, we can take. Now, there are serious alternatives. I mean, Milton Friedman gave that particular idea, and there was a gold standard and other things. And I don't know if I can test your patience, but for various reasons...
I said it would be a short question.
A short question. So my own research, for example, was on the Great Depression, and one of the contributions that I and others made was that the malfunctioning of the gold standard, which tied together the monetary policies of every country on the gold standard, was one of the major causes that the Depression became international. And so there are a lot of dangers and risks with the gold standard, not to mention practicalities that would be difficult to put in place. There are good reasons why we left the gold standard in the 30s and then got rid of it entirely later on. So I guess my question would be, well, the Fed is not perfect. It's not a perfect system. But compared to what? And there doesn't seem at this point, I mean, just the evidence is that there, of 180 countries or so in the world, there are a couple that share a central bank, but I don't know of any that doesn't have at least, that doesn't have a central bank unless they use somebody else's currency. So somebody's got to run the monetary policy. Somebody has to determine how much currency is to be issued. Somebody has to deal with the issues of financial stability, and in modern economies, that's the central bank. And I believe that will be the case in the United States, and I hope that it will be an independent and highly qualified central bank that does it.
Okay, and now the interesting part. The question's really important. Coming from our group here, I can't see because of the lights, but who has the microphone? And yes, right over there, sir. Please try to ask a fairly short question.
Yes.
And don't give a long speech.
I'm a banker and a real estate man from Illinois. And we just opened a new branch in Washington area last week. And we are a good bank. I would say the Wall Street is criticized so much for their unethical practice. But I am one of the real estate disciplinary board member, and throughout the practice, I see that the subprime mortgage and these problems are really caused by excessive real estate brokers, mortgage brokers, and greedy public, some greedy consumers.
So what is your question for the chairman,
and
please?
So all these, to correct these basic, deep-seated roots, I think we need, America needs civic consumer education, because surplus countries has very concerned consumers, whereas America has totally indifferent consumers.
You know, you may be right, but we are limited with time. Would you give an answer to that if you care to?
Well, certainly. The subprime problem was certainly part of the crisis. It wasn't all of it by any means, but there were a lot of reasons for it, including inconsistent regulation. Federal Reserve bears some responsibility there. We have put together regulation on mortgage lending, but it came too late. But another aspect of it certainly was the understanding of the borrowers. And financial literacy is an incredibly important objective. We work for that at the Federal Reserve, but I think now that we've seen the dangers of people not knowing what they're signing, I'm very hopeful that there will be a much more committed effort in our school systems and our colleges and for adults as well to help people understand how to navigate the financial marketplace. It's very, very important. I agree with that absolutely.
Yes, ma'am. A question right over here.
Great. Yeah, Cindy Arnson. I'm the director of the Latin American program here at the Wilson Center. Dr. Bernanke, over the years you've made a number of statements about rising income inequality in the United States and overall the decline in real wages. And in light of that backdrop, even before the financial crisis, I was wondering if you could offer some thoughts about what that augurs for the future of free trade agreements between the United States and developing countries in the world.
I did speak about inequality. Rising inequality is a problem in the United States. There are a lot of reasons for it. They include technological change, which favors more skilled workers over less skilled workers. To a lesser extent, there are factors like the weakening of the union movement and some trade factors, which again favor more skilled workers over less skilled workers. There are a lot of reasons for it. There are dangers because one of the political implications of increased inequality might be protectionism. It might be that people will say, well, we have to close our borders because we want to prevent cheap goods from coming in, et cetera, et cetera. Economists are pretty broadly agreed that a very big source of growth and prosperity is trade, We don't want to have trade cut off, but at the same time we are concerned about the inequality. They're not easy solutions there, but I think that fundamentally, if the problem is skills, then the real solution is getting skills. I'm going to go on Wednesday afternoon to Richmond to talk at a conference which is about workplace worker skill acquisitions, junior colleges, community colleges, state programs, and so on. Give people skills, and then they can get the kind of work that will give them a decent wage. That's even more critical today than normal, because one of the very disturbing aspects of our labor market situation is that about half of the unemployed have been unemployed for 6 months or more, which means that they are losing skills, they're losing contact with the job market. If things go on and they simply sit at home or work very irregularly, when the economy gets back to a more normal state, they're not going to be able to find good work. So even now, it's more important than ever that we make available in every way we can, not just through K-12, but through all kinds of different venues, opportunities for people to get skills so that they can get decent paying jobs.
Final question, right over here.
Chairman, is it likely that this country will ever have much leverage in negotiating with China?
You've just come back from China.
I just came back from China. I attended the what's called now the Strategic and Economic Dialogue, which is both strategic, bears on State Department type issues, and economic, Treasury, Fed type issues. I am one of the few people, maybe perhaps the only person on the American side, who has been to all of them, because they were founded. This basic meeting was created by Secretary Paulson in the previous administration, and it has continued with some modifications into the current administration. And what it is a meeting of essentially the entire cabinet of the United States, plus the Fed chairman and others, with their counterparts in China. And what I thought was the genius of that of this meeting is that it recognizes the wide range of issues in which the U.S. and China have common interests and concerns. So when we go, we just don't talk about exchange rates and some of the things that have been such a troubling part of our relationship. We talk about ways in which we can cooperate on energy and on investment and on trade, on visas, on many, many other issues, both on the economic side and on the strategic side. And the fact is that they need us and we need them, and we are the Chinese and the Americans are respectively the largest developing and the largest developed economies in the world. And we have a great deal to gain from working with each other. And one of the benefits of these meetings, besides the concrete achievements, which are sometimes bigger and sometimes smaller, is that we are establishing a working relationship. And having a working relationship with people so that you can call them and talk to them and get a frank answer is a very important objective. And so my answer is that we are talking to China, and we need to keep talking to China, because it's not just a single one or two issues. There's a tremendous range of issues where these two countries need to work together.
But do you see China likely listening to us on areas of monetary policy
they watch us.
They control the money?
Well, they have their own views and interests that we don't always agree with them, certainly. But they are very interested in what the United States is doing and thinking, and they understand that there's a sort of codependency relationship, and they certainly want to engage with us. Now, obviously, we're not going to be happy with every outcome, and certainly we're not. There are lots of issues that we're currently debating with them, but all I'm saying here is that there is I think, a real desire on both sides to engage, and that, for me, that is a very important achievement to have those lines of communication be open.
And someday they will revalue their currency. Someday. Chairman Bernanke, when you came to the post, you said you wanted the Fed to be more transparent, their work, the Americans, and we certainly believe you have been tonight, and we appreciate you coming. Thank you.
Thank you very much.
That was excellent. Thank you. Okay.
Okay, before we leave tonight, may I recognize we have several awardees who are present: Robert Fischel, Tom Ridge, Marlon and Fred Malik, and Matt Rose. Thank you, especially former awardees of the Wilson Center. We're delighted to have them. Please give them a round of applause. And we're very appreciative of Chairman Bernanke and his comments tonight, but I thought Sam Donaldson did a great job too, didn't you, in questions? So, Sam, we appreciate that. I hope you've had a wonderful evening. It's been our pleasure to have you here. Godspeed to all of you and a safe trip home.